Are you looking at a falling trend with glaring sell signals or a strong buy that some are whispering is still completely undervalued?
I mean, that is the million-dollar question today, right?
It really is. Welcome to the deep dive, everyone. Before we get into the weeds, just a quick reminder to like the video, subscribe to our YouTube channel, and you compulsory have to leave your feedback in the comments. We want to hear your theories on this.
Yeah, please let us know what you think.
And I need to explicitly state right up front that this deep dive is an exploration of the data. It's an intellectual debate and absolutely not financial advice.
Bro, definitely not financial advice. We're just analyzing the numbers here.
Exactly. So our mission today, it is April 23, 2026, and we are unpacking the extreme volatility of Applied Optoelectronics, ticker symbol AAOI. We're breaking down the financials, the technicals, and that really fierce bull versus bear debate.
And, what's fascinating here is the company's fundamental identity crisis. We're looking at an organization transitioning from a pretty slow-growth networking component provider into a hyper-growth AI infrastructure player.
Which is a massive pivot.
It is. And the public markets, they really struggle to price that kind of metamorphosis, which creates these violent inefficiencies on the chart.
Okay, let's unpack this. Because before we even look at the company's bank accounts, we need to establish exactly what the stock price is doing right now, because it is giving people whiplash.
Oh, absolutely.
Like today, we're looking at a current price of $137.73. And it just took a pretty nasty 7.82% drop in the most recent session.
Yeah, that was a heavy hit. But if you zoom out to the 52-week range, it's staggering. It climbed all the way from $11.54 to an all-time high of $173.41.
It's just wild. I mean, year to date, it's up over 338%.
Which is incredible momentum. But technically speaking, it's trading right near that upper resistance. It's way above its 50-day moving average of $94.
And miles above the 200-day, right? Which is what, sitting down at $45.71?
Exactly. And the RSI, the Relative Strength Index, it recently hit this extreme overbought level of 88.84.
Yeah, and hitting an RSI of nearly 89 is like, well, it's like redlining a sports car engine. You might be going incredibly fast, but if you don't shift gears, something is going to blow.
That's a great analogy.
So with volume high, like 11.6 million shares trading daily, is this 7% drop just the engine cooling off, or is it a sign of a real breakdown?
Well, the primary uptrend is undeniably strong. But mathematically, a short-term corrective phase was just totally overdue.
Right. Gravity has to kick in eventually.
Exactly. But if you look at the order flow, that high volume from $11 up to 100, that indicates massive institutional accumulation the big players were buying.
Okay, but what about right now?
Well, this recent drop signals that they are taking profits. They're using the liquidity at the top to exit, which leaves retail traders who are still heavily bullish potentially holding the bag.
Yikes. So retail is buying the top, while the smart money is quietly slipping out the back door.
Pretty much, yeah.
But that makes me wonder why institutions were buying so aggressively in the first place. Like, we have to transition from these technical charts to the raw financial data under the hood.
Right, the actual numbers driving the AI hype.
Yeah, so looking at their income statement, the trailing 12 months going into 2026, revenue is at $455.72 million.
Which is a massive 82.75% annual growth rate.
That's huge. And gross profit sits at $136.91 million, so their margin is hovering right around 29.96%.
Yep, the margins are improving because of the product mix shift.
Here's where it gets really interesting, though. Their net income is still negative. They're bleeding $38.23 million.
True, but you have to look at the context. That is vastly improved from the negative $186.7 million they lost in 2024.
Okay, sure, they stopped the bleeding a bit. But EPS, earnings per share, is still negative 0.63. They are losing nearly $40 million a year, yet the stock is up 338% this year. How do we reconcile this?
If we connect this to the bigger picture, the market is pricing in future AI-driven data center demand.
Yeah.
It's not about present realities.
So it's all about what they will do, not what they are doing.
Exactly. And that negative $1.63 EPS, that actually beat Q4 2025 estimates by an astounding 92%.
Oh, wow, 92%. That's a huge beat.
Right, so it shows a trajectory of rapid financial healing. And if you look at their balance sheet and cash flow, cash is up significantly year over year.
Yeah, I saw that. They're sitting on $206.14 million in cash now, up from just $67.4 million.
Exactly. Now, their total debt does sit at $248.08 million, which puts their debt-to-equity ratio at 33.8%.
Which is, a decent chunk of debt.
It is, but the cash position growth proves they are arming themselves for a massive scale-up. They're preparing for something big.
So, armed with these financials, we have to debate the core question here. Is this stock genuinely an undervalued innovator based on future growth? Or is this just a classic value trap built on AI hype?
Right, because traditional valuation metrics like their negative PE ratio and
Yeah.
high forward price to sales, they literally scream overvalued.
They really do. But the proponents, the bulls, argue it's undervalued if they hit their $1 billion revenue target for 2026.
Yes, that 1 billion target is everything.
So let's talk about the bull case. They apparently have a first mover advantage in these 1.6 key data center transceivers.
Which are absolutely essential for modern AI clusters. You can't run these massive NVIDIA GPU setups efficiently without high-speed optical networking.
Got it. Plus, they have a really stable partnership with Amazon, right? Including manufacturing agreements and stock warrants.
Exactly. And to meet this ravenous demand, they are doubling their Houston manufacturing footprint to 900,000 square feet.
Okay, but let's play devil's advocate for a second. The bear case points out a massive execution risk to actually hit that $1 billion goal.
Oh, without a doubt.
And there's really heavy customer concentration. They rely so much on hyperscalers like Amazon and Microsoft. To me, it's like, well, it's like building this massive state-of-the-art kitchen just to host a dinner party with only 2 guests.
That's a very vivid way to put it, yeah.
Right. Because if Amazon or Microsoft decide they aren't hungry, AAOI's entire 900,000 square foot kitchen just goes to waste.
That is exactly why the valuation is so polarized right now. The $1 billion target is the entire linchpin for this stock.
So if they hit it, they fly.
Right. If they deliver the 1.6T transceivers successfully, traditional PE metrics won't matter because the growth rate will just outpace the multiple.
But if they don't,
If they face order delays or manufacturing hiccups in that new Houston facility, it becomes a textbook value trap.
which brings us to the structural risks of trading this stock right now, especially for you listening if you're tempted to just jump in on a dip.
Yeah, you have to be so careful here.
Let's look at the beta. It is sitting at 3.22. That is extremely high volatility. I mean, it's basically like riding a roller coaster without a seatbelt.
It really is. A beta of 3.22 means if the broader market sneezes, AAOI catches a severe cold. Or, on the flip side, a massive fever to the upside.
So why do retail traders always seem to get trapped in these exact types of setups?
It's the sentiment cycle. Retail traders get trapped because they buy when the headlines scream extreme greed near that $173 resistance level.
Like FOMO, basically.
Exactly, fear of missing out. But while they are buying, institutions are using that exact liquidity to exit their positions.
Wow. And the sentiment has really shifted now, hasn't it?
It has. Following this recent drop, the momentum and sentiment have shifted from extreme greed down to neutral, or even cautious.
Which makes sense given the price action. So where is the floor?
Well, there was heavy selling near that $173.41 peak. Now the stock is testing its support at $132.63.
That's a critical battleground right there.
It is. And if that short-term weakness continues and that level breaks, the next major support isn't until $113.
Ouch. That's a long way down. No wonder the analyst ratings are all over the place.
Yeah, the ratings range wildly. You have sell and hold ratings because of the negative signals in the short-term outlook.
But then you have Rosenblatt Securities raising their target to $140.
Right. They see the 1.6T rollout as a massive catalyst.
So what does this all mean? We have all these technicals, the financials, these crazy risks. Let's outline the concrete scenarios for the short term versus the long term.
Yeah.
Are we just holding our breath until the upcoming earnings call on May 7th?
This raises an important question about investor patience. Because in the short term, the chart is definitely showing consolidation.
Like chopping around between levels?
Yeah, digestion of those recent massive gains. We expect it to consolidate somewhere between $130 and $150 leading up to the catalyst.
Which is that May 7th call.
Exactly. Long term, though, it's a completely binary outcome. It's based entirely on the 1.6T rollout execution.
So what's the best case recovery scenario?
If that $1 billion revenue is realized, analysts see a clear path to $190 or higher.
And the worst case continuation lower?
If growth stalls or there's an issue with the Amazon or Microsoft orders, a retracement back down to the $100 level is highly likely.
Wow. Okay, so to synthesize all this for everyone listening,
Yep.
we are watching a company transitioning at breakneck speed.
A total evolution.
Right. They are battling massive volatility. They're heavily reliant on just a few tech giants, but they are armed with what could be a golden ticket, the 1.6T transceiver.
It's high risk, high reward in the purest sense.
Which brings me to a final thought for you to explore on your own. We know institutions were taking profits near the top while retail kept buying.
Standard market mechanics, yeah.
But the real question you have to ask yourself before that May 7th earnings call is this. Are the smart money algorithms just taking a quick breather before the 1.6T transceiver revenue actually hits the books? Or do they know something about those Amazon and Microsoft orders that the rest of us don't?
Oh, that is the scary part to think about.
It really is. Well, thank you for joining us on this deep dive. Don't forget to drop your own theories in the comments below, like and subscribe. We'll see you next time.